Okay, Master Traders, we are on Module 6 of Moving Averages, so we are just about halfway into the seminar here. And as we go further, I'm going to start reinforcing more and more of different trade setup concepts, trend concepts, bar-by-bar analysis, continually reinforce the education. What is a setup? Why is it a setup? And in this case of moving averages, why are we using a subjective analysis tool? We are vehemently against subjective analysis as it relates to trend lines and Fibonacci lines and oscillators and so on. But as you'll see, this is an extremely valuable tool that we can use to speed up the analysis process. So let's continue. So they're very versatile, as I've said, and if you know how to use them, how to interpret them, realize they're not real support and resistance. Many will refer to them as such, as a 200-day especially being an area of support. It certainly does and can become a self-fulfilling prophecy since so many are looking at it, especially on an index like the S&P 500. 50 MAs, 200 MAs are widely used by institutions, mutual funds, and such, and even arbitrarily as being support and resistance where they'll actually buy at those reference points. Now, what we want from them is to eliminate the subjectivity and eliminate any indicators. We want to keep our charts free of indicators, but as you'll see, if you use these intelligently, they can speed up the analysis. And if you watch us in the green trading room or one of our webinars when we're scanning, you can see how quickly we go through it, because one of the ways that we use these moving averages is to see the alignment of them as they relate to price. So as your eye becomes trained to look at these pictures of where price is in relation to these moving averages and whether the moving averages are above or below each other or intertwined with each other, those pictures immediately project a message. And this is what we want, an objective way to speed up the analysis and recognize that picture. So we're going to use simple moving averages. Let's clear up any questions as to what we're using or why. If you like exponential, for example, if you were trading Forex, you might decide to use exponential because that's what other Forex traders are using. There's a tendency when there's more leverage involved to where traders will moving toward more esoteric type of analysis, looking for that holy grail. But in reality, simple moving averages work on anything. It's all about being consistent in what you're using and what you're looking at. So we want to watch the slope of a moving average as an indication of trend change, primarily the 20 and then the 50, since they're faster moving averages, obviously, than, say, a 200. The faster or the shorter the moving average is, the more closely it will track prices. Converging moving averages point to inflection points. Why? Well, because if the moving averages have come together, there has been a decrease in volatility from what it was prior, and the more recent price action is staying about in the same area. So a longer term moving average and an intermediate term moving average, or even a longer term moving average, they're going to begin to come together the longer the consolidation is. So simple moving averages, by definition, just simply drop off the period. For example, 20-period moving average 20 periods ago is dropped off. The new value was added in, and then that is added up, those 20 numbers, and then divided by 20, and there you go. You have a new plot for that moving average. So as time goes by, as you are averaging in the 50-period moving average or the 200-period moving average, the longer the base, the more those moving averages are going to come together if they were further apart. And then as prices begin to trend either up or down, and the new values that are increasing either up or down are averaged in, and the speed in which those numbers change, the moving averages will then spread apart. So when we view the distance between those moving averages and the distance between prices in the moving averages, we immediately are provided with a picture. And as I said, we're looking to just speed up the analysis. Obviously, we can see this just by looking at prices alone, but we are looking to speed things up. We're training our eyes to look at a certain picture. And when we recognize that, and we recognize what we perceive to be, from historical analysis, a picture of money, we stop and we look a little longer. We do some bar by bar analysis, and we then decide, is this an opportunity to place a trade? So the moving averages that we're going to use for swing trading, on the monthly MA, it's going to be a 10-period moving average. I'll explain why in a moment. On the weekly, we're going to use a 20-period moving average. And on the daily, we're going to use the 20, the 50, and the 200. So the master trader approach, looking at the daily time frame, is to be aware of what's happening in multiple time frames, the ones that we use, the weekly and the monthly. And we're going to be focused on what the trend is on those as we look at the daily time frame, and we'll then get insights as to what's happening on those other time frames. So let me show you how to calculate that and plot it on one chart. This, like pretty much everything that we do, revolves around simplicity. And things are simple once you know. It's an obvious statement, but it's true. Things that seem complex or confusing to you, once you understand it, all of a sudden it's simple. So how can we do this with moving averages? Well, what we want to see is the trend and location of one moving average from one time frame to another. So we have to do a small calculation of the number of bars in the lower time frame that make up a higher time frame. Then we simply multiply that number by the moving average in the higher time frame. That's your moving average in the lower time frame. And here you have examples. So a weekly 10-period moving average is the same as a daily 50-period moving average. You've got 5 daily bars equals 1 weekly bar. So we take 5 bars, multiply that by 10, and we have a 50-period moving average. Now, depending on the direction of that 50-period moving average on the daily time frame, we have a pretty good idea the direction of the weekly trend. So the weekly 20 MA is the same as a 100-period moving average on the daily. 5 bars times 20 equals a 100-period moving average. Now, you're probably already thinking, well, you didn't mention using a 100-period moving average on the daily time frame. Correct, because I know that the 20-period moving average is on the weekly, which I'm always going to be looking at, so I'm going to know where the 100-period moving average is on the daily time frame. On the monthly, we're going to use that 10 MA, same as the daily 200 MA. There's 20 trading bars on a monthly time frame. Multiply that by 10, and we have a 200-period moving average on the daily time frame. Here we have a daily time frame with the 20, the 50, and the 200. And I always keep my moving averages the same color on whatever the time frame it is. And so that 20 MA is blue, the 50 is green, and the 200 is red. And as I'm looking at this, I see that the 20 MA is above the 50 MA. Both moving averages are above the 200 MA. And the 20 and the 50 are trending higher. And I take notice of the distance between those moving averages. So, for example, let's look at a few spots on the chart here. Where prices move out of this consolidation, you notice the wide range bar. Notice the volume. Now, as I said, volume is a secondary piece of information, and our primary focus is volume spikes. So when I see a wide range bar coming out of a consolidation, and consolidations will bring the distance between the moving averages together. So I know that prices are not extended just by looking at this picture. Now, you can look at prices and see them going sideways and say, of course, they're not extended, but you'll see how this becomes important as time goes on to measure what's happening through the eyes of these moving averages. So we've got a wide range bar igniting out of a base on increasing volume. Terrific. Suggests that prices are going to go higher. Now, wide range bars, as you already know, are momentum moves in a smaller time frame and create a void. So prices continue to move higher, and there's your void there. Now, prices are not that extended from the 20 MA. This is a visual representation. You can see here they weren't that extended, but the 20 and the 50, they were a little further apart. Still not a problem. Consolidation, and then the move higher, and now a bullish consolidation where prices catch up to the 20 MA. That in of itself is going to tell us pay attention. Now, of course, we're paying attention along the way, but our highest probability setups or situations are going to be when prices become relatively close to the 20 MA after a momentum move higher, and sometimes prices will retrace lower to the 20 MA, but when they go sideways, it's even more bullish because they didn't pull back, and this is the concept of creating support by going sideways after creating a void. Bullish price action. Now, I hope you're looking at this and taking notice of the fact that that bottoming tail bar broke below these lows and then traded back up again. That's what I call an event. Pay attention. That event means buy it above that bar's high, put a stop below the low, and then bar by bar analysis, see what's happening. Little bottoming tail bar, which was a tiny little red bar prior to becoming a bottoming tail bar. Buyer stepped up on the dip. Move higher, move higher, move higher, move higher. Higher, getting further from the 20 MA. Topping tail. Are we selling? No. Can you sell partial profits? You can decide to do that, but this move is getting started here. It should go higher. Other things that you're doing here is you're looking to the left. Is there a void that prices are moving into? We're looking at these moving averages and saying, hey, the weekly time frame is just getting started too. The 200 MA, which is the 10 MA on the monthly, prices just got above it. And the 200 MA is just starting to flip up here. So we can see through multiple time frames that this move is really just beginning, even though it's already moved from, say, at this point, $13, $14 up to $25. So we look at this objectively and say, well, prices moved up quite a bit here, but who's to say that they can't go up even more? And this is what keeps us in a great swing trading opportunity when we can look at it objectively and say, all right, it's short-term extended, but this is really getting started. Maybe it needs to consolidate a little bit, but you can see here it only consolidated a little bit and then continued to go higher. So bar by bar analysis, you'll recognize retracements. If it does retrace, if it goes sideways, bullish price action, everything that you're learning at this point is going to help you objectively look at what's happening. Lastly, odds are on the long side unless prices have moved up climactically. What is climactic? Far away from the 20. Moving averages are separating apart. And over time, as you look at charts, you'll see that some stocks move much further than others. So you could say, well, percentage-wise, is that a guide? It can be, but I've seen many stocks move much more percentage-wise than others. So you'll learn what's climactic, and just this picture right here is what I would call maybe pre-climactic. The more bars that you have going up in the same direction that are opening in the area of the prior bar's close or gapping and going higher, the more of them you have going up and more of where prices start to move vertically, the odds are increasing of a pullback or a consolidation. It doesn't mean that prices are going to collapse, crash, or some point where there's going to be some devastating type of loss against you. You can't think that way. It's just looking at it objectively and bar by bar, multiple time frames, and observe and see what happens next. Taking partial profits, nothing wrong with that. And then you're going to have to just sit through some correction if you believe that prices are going to be able to go higher. Now, this is how we would look at our daily, weekly, and monthly time frame. And you can't see the 200 here As it's a little further away, you can see where the 10 is here at about $60. And so you can't see where the 200 is, but we know it's down below here when we're looking at the monthly. We don't have a 100 MA, as I said, on the daily, but I look at my weekly and that 20 MA there, and I know that the 100 MA is going to be at around $64 or so. So I would know it's right around here where this consolidation is. And here we see that the 20 is above the 50. Over here, they were pinching or converging at that point, and then we had this bullish professional type of gap up where it came out of a consolidation. Notice the volume. So we have a volume spike on the gap and a bullish wide range bar. That suggests prices are going to go higher. If you apply some bar by bar analysis, think about what happened on the second bar after the wide range bar. Looks pretty bullish, doesn't it? So what we have there is a bar right here, which was a big red bar that retraced deeply into the wide range bar. Now, one of the concepts that I spoke about is that after a wide range bar, what we want to see is prices stay in the upper half or the upper third. And what we specifically want to see is the candle body staying up there. There are going to be times where you're going to see retracements into a wide range bar. But what we want to see is that buyers step up and we get a closing price up in the upper half and ideally the upper third of that wide range bar. Daily chart here, different picture, obviously. Now you can see the 200 is intersecting prices. You can see where the 10 MA is on the monthly time frame, and it's not going to be exactly the same price. So if you're looking on your platform and you're looking at the prices, you're going to see it's there, give or take a little bit. Meaning it could be pennies from a monthly to a daily. It could be a dime. And again, it depends on the price chart stock that you're looking at. But what you want to realize here is that the concept provides you as to what's happening in multiple time frames by looking at just your daily time frame. So here I know where that 10 MA is on the monthly, which tells me that things are going sideways there. This 200 MA isn't pointing up, it's flat. However, the price action here is such that it was bottoming. Notice the wide range bar coming out of the base, and notice the bullish consolidation right there at the top of the wide range bar. Notice the volume down here. That volume spike says, hey, pay attention. Now as prices come up into some area of congestion, we need to look to the left to see what's there. And looking at the monthly chart and looking at the weekly chart, we see that there really is a reference point of congestion there. And also this gap down here is certainly a concern. So what do? Well, if we're continuing to watch this particular stock, at this point I'm thinking to myself, well, this just got started out of this base here. The weekly came out of this support area down here and come up to resistance. Can this repair the damage? In other words, I need to see this now start going sideways and buyers start to come in. You know, the monthly did have a correction here. As I look at multiple time frames and I look at this particular example, it tells me set an alert, stand aside for now. Maybe this could develop after a while of some consolidation, some breakdown failures possibly. And then if it can recover from here, well, then the door opens to a larger move back up. But wait and see here. But what we want to take away from here is understanding, looking at our moving averages and the pictures that it's providing for us to understand what's happening, and again, to speed up the analysis process. All right, we're back to one time frame here, the daily time frame with our 20, our 50, and our 200. So let's take a look at what's happening. So on the left side of the chart, we have the moving averages aligned in a bearish alignment, meaning we've got the 20 under the 50 under the 200, the 20 and the 50 are declining, and as they are, a bottoming process begins. Well, before the process begins, there's that volume spike. Remember, when it comes to volume, our primary focus is spikes, which says pay attention. There was a big increase in activity. We don't know what it's going to do, so watch. What happens next? Apply bar by bar. A complete reversal of a red bar now being ignored that formed on huge volume. Does that mean we want to go long? Absolutely not. This needs to prove itself. We need more information. This trend is lower. Now, you would be looking at what's to the left here. Why is this happening? Remember, we're always asking why. Why does prices turn at a certain location? And the vast majority of the time, it's going to be when you look to the left, there's support there, or in a higher time frame, it's at some reference point of support, or the trend might be up. So remember, you look to the left. Now, that move up was a power move higher. It moved up where it initially gapped up above the green bar, and then it did not fill the gap. It continued to move higher. There was a wide range bar moving up, and it just moves to the upside with no hesitation at this resistance. And then when it gets to the top part of the resistance, which is 100% retracement of the prior decline, which would be a bullish bar or bottoming tail in a higher time frame, what does it do from there? So we ask questions about patterns, meaning the current pattern, I see what it says and what it communicates to me. What occurs after that? Now, you're going to see what occurs after that, but by knowing historical patterns, we know what should happen and we know what shouldn't happen. So think about what shouldn't happen. It shouldn't go all the way back down to the low. What should happen is a very minor retracement to an area of minor support, or more bullishly, it should go sideways and create support. And that's exactly what this did here. It went sideways. So when it hit the 200, a subjective reference point, but that is in alignment with this resistance area here, it attempted to go down and it stopped. And then when it came down to that area again, it formed a bottoming tail bar. And then it moved up strongly. Little volume spikes. Pay attention. Bottoming tail bar when it tried to dip down. So the message here is that every time it tries to go down, buyers are stepping up again. Now, notice the 20 MA. It's starting to rise. And it's rising. And the 50 MA is no longer declining. It's flattened out and it's beginning to rise. Now, as it moves up here, and we've got the beginning of this move, question mark, wide range bar, volume on the wide range bar, igniting a move out of the base. So why did it pull back like this? Well, when we look at patterns, there are going to be points in time, for whatever reason. It could be market related. Some news item came out that affected the broader markets, or possibly the stock that we're looking at, but prices broke out and then they traded under the low of the breakout bar. So there you have a breakout failure. That creates a lot of uncertainty, and those that are longer saying, I better get out of this thing. Right? Well, maybe you should under a situation like that, or at least take partial profits. It's certainly a bearish event that occurred, and we don't know what's going to happen next. It could have reversed right back up again, but in this case it didn't. So there's damage done here. This is a lot of uncertainty, because what was happening here was extremely bullish. This was all bullish. This was bullish. So now we have this event that has now created all of this uncertainty. Well, as it moved down into support, we need to now watch what's happening at our reference points. That 200 is going to be a reference point. And when I see any moving average and I'm thinking, hey, this is a point in time where buyers might step up because of that moving average, I'm looking for confirmation by looking to the left. Is it in an area of support? this was bar by bar analysis. Green bar moves up, gap down, closing at the high. This is repairing the damage. And we could see this was a bottoming process. And while this is not what I would call a no-brainer long type of setup here because of the depth of retracement, it is one in which tells me that buyers are stepping up again, that damage is being repaired, and it's happening at the right location. Now we get another 100% retracement and a greater than 100% retracement, and then a gap up and another reversal that takes out the low of the breakout bar. This stock is a little bit wild or there's some uncertainty here, but it is making some big moves. And what begins to happen here, you can see this bullish price action that's occurring where it is now beginning to go sideways. You got a bottoming tail bar and it's moving up. Now, look at the moving averages here as they're out there starting to pull apart from each other, and these are, nicely above the 200. Look at the arrangement of the price bars now. Look at how they stay relatively equal in range and close together. And this becomes more of a picture of certainty after this bullish price action here. So while this was bullish and the move was just getting started and there was some erratic price action, now we see certainty that's occurring within this. And ideally this would then go sideways. Of course, you're looking to the left to see, is there a void over there? Everything has to start coming together where you're continuously doing this analysis and objectively looking at what's occurring in the stock you're looking at. And of course, you're going to be doing this as it relates to the broader markets as well. Bottoming patterns, they can display a change, and they do display a change from certainty. So in a downtrend, there's certainty about it going down. And as prices begin to bottom, there's uncertainty. There's uncertainty as to whether that downtrend is going to continue. So during this process over here, as prices began to bottom out, and you notice the retest of this area here that buyers stepped up again, and this was a relatively powerful move up here. Look at the way the bars go up. One bar closing where the opening where the other bar closed, or gapping up and it goes higher. And we see the red bar being ignored, a wide range bar without any follow through to it. So we've got this bottoming process going on here, pullback. Notice the bottoming tail bar and this red bar ignored, and then this breakout. They can provide us swing trading opportunities, but they do tend to be whippy. And we want to see that power move. We want to see it happen on big volume for that type of confirmation. That bottoming patterns do have a tendency to disappoint. They're not in clearly defined uptrends or clearly defined downtrends. So when you trade them, trade them a bit tighter, be very respectful of an event like this, to step aside. And just historically, bottoming patterns do just that. They bottom, they have false starts, they have deep retracements, they begin to rebuild again. Some stocks can take months, some could take years after a big correction. Stocks that are in uptrends in higher time frames can have a correction on a daily and begin to repair the damage in several weeks. So we put those corrections in the context of what's happening in multiple time frames as well. That gives us insights as to the probability of a bottoming pattern actually turning back into an uptrend or not. And that all being said, market environments can foil the best looking type of bottoms just because of corrections where traders just step aside during a market correction and just wait and see if buyers are going to step up again. And you might think that institutional investors maybe would stand their ground, so to speak, and hold on. Well, they will longer than a very short-term trader, of course, but they will raise cash during a period of uncertainty. They may not exit a whole position, but they are going to unload some shares if they perceive to be that there's a lot of risk involved. Common sense. So here look at this move up. Price arrangement here between these candles is pretty whippy. Prices were above the moving averages. They were above the moving averages over here. It was a powerful move up, and we get pullback, and you see that you've got a lot of overlapping bars and tails. So there's still a lot of uncertainty going on here. And as the moving averages are starting to rise, you'll notice that they're not as smooth as some of the other examples. And if you're not sure what I'm talking about, go back and look. And you can see how this has kind of a dip and goes up and some wiggles in there. In any event, you can see the price action is still erratic, where you get big move down and it comes right back up again. So we've got this downside type of shakeout where prices come up into resistance, and they actually act quite well here, where they go sideways and this topping tail doesn't follow through, and then prices break out. Well, we can see that there's something that went on over there to the left that was a pretty bearish event, that big negative down bar. It doesn't mean that this is going to happen, but if you bought that breakout and prices retraced all the way back down again, you have to say, you know what, this could be a problem. Right? This is erratic price action is still continuing. Maybe I should just step aside, reevaluate. I can always get back in again for a small commission and see what might occur. And so if you're uncertain, there's nothing wrong with scaling back to reduce risk. Now, prices eventually, they broke to the downside, as you can see. They stalled at this support area, but they just couldn't get going again. And the 20 moves under the 50. They're both starting to decline. Look at how smooth. Let's clear this up here. And let's look at this concept of how smooth that 20 is moving versus, this kind of wiggles that's going on there. It's a slight nuance, but something to take note of. So prices are moving rapidly here. When they hit support, they cannot move up very much. They drop, eventually break below the 200 MA, which is the 10 MA on the monthly. And so this monthly chart, we know, was rising over a longer period of time, because look at the 20, that 200 MA. It is rising. It was still rising, but this sharp move down broke through that 10 MA on the monthly. And on the daily, I can see that it's violated multiple areas of support. It's now under the 200, short-term bearish, and you've got this retest here, and notice this 180 reversal that occurred. Bearish event. We could short that. Now it gapped down. We're still looking for lower prices. Could this pivot low hold? Maybe. Look to the left. Why did it occur? Maybe just short-term overdone to the downside. Maybe the market bottomed. In any event, this arrangement of moving averages and trend is a bearish one, where we're looking for lower prices. Okay, so different example here. These moving averages should be jumping out at you as saying, look at the distance between the 20 and the 50 to the 200. Over here, notice the volume, a pro gap up. It gapped above the high of a red bar on big volume, and then it began a consolidation, did move down into the unfilled gap, and then we see these RBIs, red bars, being ignored. And as prices are beginning to tighten up, another pullback. So a consolidation, overlapping bars there, not something we're really interested in, other than to say, hey, this is something we should pay attention to. Let's set an alert. Let's let the software monitor this and see what happens. And just, again, take note of the arrangement of all these candles here and how the arrangement changes here. How the bars stay relatively close in size. There isn't a lot, there's hardly any red bars here. We've got one little red bar here. Most of the closes are above the opening price and they move up. And then after it gets a bit extended from the 20 MA, and the 20 gets a bit extended from the 50 MA, and they are getting extended from the 200 MA. We see the 200 is rising here, but prices go sideways. And once this pivots and retests, red bar being ignored, this is bullish price action. This stock is going to go higher. Look at this pullback and retracement into the rising 20 MA, and now look at how this corrective action brings the moving averages together. So again, a visual aid that helps speed up the analysis process. I hope you're starting to see all of this, how powerful it is and how it can come together when you combine it with bar by bar analysis and trend analysis and looking at the volume. Notice the volume spike that occurred right there on the move up. So all of this puts the odds in our favor as we put all the pieces of this puzzle called technical analysis together in a master trader way. I think you can see how powerful and what an excellent tool these moving averages are as a visual aid. They're not real support and resistance, only price is, but they can become a self-fulfilling prophecy, especially the ones that we use on the daily time frame, because institutions use them. They're focused on as buy areas, the 50 MA, the 200 MA. So that's why we use them, and we use them in a simple way. Simple moving averages, not exponential, not weighted, not triangular, not optimized. Right? We keep things simple. That truly is the key to success, is simplicity in what you're looking at and the combination of the concepts we're talking about. We don't trade a moving average per se, but they're an excellent tool. And if you use them the way I've explained, you're becoming a master trader and the dollars will follow. Let's move on to the next section.